Check it.
Who in here is a business owner? Raise your hand. A lot of you. You can put your hands down. Anyone own a restaurant in here? Got one here, a couple restaurants. I want you to imagine you own a restaurant. Would you eat dinner and take your friends and your family to your restaurant? Yes. If you owned a salon, would you get your hair cut at your salon? Absolutely. You wouldn't go to the people down the street, would you? No, that'd be silly. If you owned a gym, would you work out at your gym? So whoever goes to the gym, do you ever not see the owner of that gym working out in their own gym? So last one. If you owned a bank, would you make deposits in your bank or Bank of America? Your bank, right? Okay. If you needed a loan for a car, a house, or something else, a rehab, would you go to your bank and borrow the money? Yeah. And if you borrowed money from your bank, would you pay your bank back with interest in principal? Absolutely. You wouldn't steal from your bank. You wouldn't steal from your gym. You wouldn't steal from your salon. You don't steal from your business. Why? Why don't you all have your own bank? Tell me, why? Exactly. That is the exact, whoever said that, come up and grab the last book here. You haven't learned how to do this yet. We are about to. And I'm going to get through this as quick as I can, but here we go. I'm going to show you a 200-year-old concept that has been used by the wealthiest families in history. You know who those are? Anyone over here who know who the Rothschilds are? Okay. Rockefellers, you got it. Who else? How about Ray Kroc? What did he own? McDonald's. Does everybody know that McDonald's is not in the business of selling burgers? What business are they in? Okay, you know how they started that business? I'm going to show you. Walt Disney World. You know how they started that business during the Great Depression? He was broke. I'm going to show you. Doris Christopher, Pampered Chef. She sold it to Warren Buffett for billions. I'm going to show you how she started her company. They were all their own bank because they learned what you don't know. So let's get into it. Being your own bank is not hard. It involves you having three things. Number one, you need a machine. And all that machine is going to do, write this down. Your machine is used only for one thing, and that is to run your money through it. That is it. Right now, you use somebody else's machine called the bank, called Wall Street. You're going to change one thing, and that is where your savings, the money you keep, law number one of wealth, is the 1/10 of your gross income. Where that 1/10 goes is going to change. And it's going to go into this machine, and that machine is then going to move that money out, and you are going to participate in something that I'll show you instead of just telling you that will change your life. I know this because it's changed my life. It's changed 4,500 other people's lives because of my direct teachings. That is powerful for me to say that. I couldn't have said that 10 years ago. I couldn't have said that 5 years ago. This machine. All right, before I even tell you this, do you remember what Will Rogers said? The biggest problem in America is what? That's right. Do not judge this because you don't understand this. This machine is nothing more than a dividend-paying whole life insurance policy from a mutually owned company. I'm watching. This is the point where people want to go to the bathroom. Sit your asses down because you think I'm talking about a regular whole life that you bought from your broke-ass brother-in-law. Or you're thinking about the life insurance store down the street and you're saying, oh man, that's the one I'm going to go to. No. This is a specially designed and engineered whole life. And a lot of people still have questions. Yeah, but Dave Ramsey and Susie Orman said this is a terrible place. I'll agree with them. If you put your money in a regular whole life with the expectations of it doing what I'm about to show you, you are going to be really upset. This is a specially designed and engineered whole life. Just like the Ford Focus in the dealership. When you go in there and look at a Ford Focus, who gets super excited? Honey, that's the car. Can't wait to drive that. No. But then all of a sudden you're home and you're browsing YouTube and you find this guy, Ken Block. And he's got this YouTube video going 130 miles an hour in full control around a turn in a Ford Focus. That Ford Focus is different than the one in the dealership because of what? Design and engineering. The specially designed whole life that we design looks nothing like life insurance. It looks more like a supercharged bank account. And you know what? Many of you are still not believing this because Kent, when I first presented this, he's like, no, it doesn't work that way. And I said the same thing. When I heard from this guy, Mike, about this, I'm like, no, dude, I'm an advisor. They don't work that way. Look this up and write this down. BOLI, B-O-L-I. Google it. Stands for bank-owned life insurance. What you will find is that banks own more whole life insurance, not IULs, not term insurance, whole life, than they own in land and buildings combined. Not only do they own more whole life, banks continue to keep buying and buying more. So you got to say to yourself, are banks stupid? Or do banks know something I don't know? Because there it is, folks. This is what Kent looked at, FDIC.gov. All these top banks, you guys recognize them, right? Bank of America, Wells Fargo, JP Morgan. Look at that number. That's a big number, isn't it? $75 billion banks put into whole life. They're not stupid, folks. They're smarter than I am, smarter than you are. We just got to mimic them. So how does a bank work? What do? You make money, and what have you been lied to and told to do with your money you make? Yeah, what do? You put it in the bank. And what's the bank do? They pay you an interest rate, right? Let's just pretend it's 4%. Now, when you make a deposit in the bank, that feels good, doesn't it? Even after you get your dumb sucker. That deposit is an asset to you. That's why it feels good. But that asset is a liability to the bank. So the bank doesn't want liabilities, which is why earlier I told you banks move that money. They make it go to work, and they lend it to your neighbor. Your neighbor's buying a new house. They lend it out to your neighbor at 7%. You're happy you hate your neighbor anyway. Like, dude, get the hell out of here. And then your neighbor takes the money from the mortgage, pays the seller, and the seller does what? What they've been lied to about, puts it back in somebody else's bank. Bank then moves it out. You're buying a new BMW M4, sweet car, and they charge you 8%. Don't get hung up on the numbers. 4 is not real, neither is 8 right now. They lend it to you for that. You pay the dealership, and you actually do drive it. You don't wait 5, 10, 15 years, and they put it back. We'll go around the wheel again. Home remodel, you do that. It's a second position, so they charge you more money. So there they charge you 9%. You pay the contractors. Maybe they put the money in, maybe they don't. And then you go to Las Vegas because you're like, come on, this event was awesome. We got to go spin the wheel. And you put it on black and it hits red, and you're like, shit, thank God what happens in Vegas stays in Vegas. Because you rack up a bunch of debt, but you go back to the bank and you say, hey, I need a debt consolidation loan. They say, yep, 12%. Great. You pay off Visa at 20 and the money goes back in the bank. Every one of these transactions, who was in control? The bank. How much risk did the bank take? Well, they took some, but not much. And the bank did what with your money? Made it work for them. Folks, we got to stop working for money, and you got to start making your money work for you. Because otherwise, the bank is going to keep making spreads like this, 4 minus 7. I'll put it up on the board. And I'm going to give something away here. I'm going to give something cool away. So I'm going to put these numbers up. So the bank pays you 4, lends it out. Let's see, get them all up on here. Here we go. It's a little behind. Here we go, 20. And in doing that, the spread between what they pay you and what they lend the money out is 20%. Is that what the bank made? Can anyone tell me how much money, in the terms of a percentage, how much more money did the bank make than you did on this? Right there, the numbers are right there. 3 seconds, and I'm going to give you a year subscription to our community with group coaching. Come on. It's a percentage. What percentage? Hurry up. Keep going. You son of a pup. He got it, and now I got to give him some. 500%. 4 divided into 20 is what? 5. 5 times more is 500% more than you. Look it up. BauerFinancial.com. Banks make 400 to 1,300% more than you do. You guys pissed now? You guys want that to change now? Good. You want me to show you what your bank looks like? And what is your bank? Does everybody know what your bank is? What's the machine? Really? You guys forgot already? Yeah, it's a whole life. Specially designed and engineered whole life. Look at the numbers on this screen right here. This is a real client. His name's Kevin. Not a big plan. He put 50 grand. He had 50 grand sitting in someone else's bank, and he shifted where that money stood, and he put it into his bank, which is that specially designed whole life. Then after that, he decided to put a little over about $491 a month every single month into the plan. And in the first year, he had $51,000 available. So he put 55 in, but he's got 51. That sounds like shit, doesn't it? Wait, I put 55 in and I can only use 51? Building wealth is a marathon. It is not a sprint. It takes time. And here's the cool thing about this. We're going to focus on the returns over here, the cash-on-cash returns, but I want you to understand something about this machine. You see, he puts this money in there. And then how many of you, who in here could use $50,000 right now? Okay, so then Kevin lends it to somebody over here, 12%. When he takes $50,000 out of an account that has 55 in it, how much money's left? 5,000 is what you think, right? Wrong. The exact same amount he put in. Because in this machine, when you take money out, you take it as a loan because the insurance company has all the money. And they just say, hey, we will give you part of your death benefit while you're living as a loan. Now, most people are like, oh, I don't want to get loans bad, loans that bad. What if the loan never needed to be paid back? Well, that's a lie because it really does need to be paid back, but it gets paid back the day you graduate and go somewhere better. That's the day it gets paid back. But we're not going to do that because you already told me you wouldn't steal from your bank. This is your bank. So if you took 50 grand out to lend it over here, what would you do when he started paying interest on that money? Whose bank would you put it back into? Your own bank. You guys are getting this, right? Look at the returns. Year 2, he puts $58.95 in his bank. And how much can he take out? $71.41. That means in year 2, the money he put in, he makes $1,246. That is a 20+% cash-on-cash return. When you put money in and you take it out every year, it doesn't matter what the cumulative return is. It only matters what your money's making each year. Everybody understands that, right? If I put it in and I move it like the bank and I take it out and I don't interrupt the compounding effect on my money, why would you ever leave the money in the account? You wouldn't. You'd find someone in this room or in the boardroom that needs money, and you'd make that shit go to work for you. You just haven't been shown how to do this. Well, I'm going to show you how. This policy is mine. I started a policy. I put 30 grand in it. I had debt. KeyBank was my bank, and I had a line of credit with KeyBank. So I changed one thing, and what did I do? What was that one change? Where my money went. Where my money went, that's it. And I put it into my policy. I immediately, in the first 30 days, took $23,000 out. Now, when I take money out of my policy, the insurance company gives me part of my death benefit, but they charge me interest on that. Would anyone have a problem if your bank paid you 6%, and then when you took your money out of your bank, they charged you 5%? Would you have a problem making 1% on money that you have in your hand? Absolutely not. You're not even getting 1% now, and your money's sitting in the bank. You took it out, and now it's making 10, 12%. I took that $23,000 out, and what I did is I paid off KeyBank. But you see, then I was like, all right, I got to treat my money the same as I treat the bank's money. So I took the $289 that I used to give to KeyBank, and instead of giving it back to KeyBank, I put it back in my bank. It's a circle, folks. Your money starts on the left, it goes over to the right to go to work for you, and then that money comes back to your bank. Is that complicated? You guys see how that works? So now I got $289, which is the same as me making 9% because KeyBank charged me 9%. Get that? How many times did you make money in this transaction? Twice, thank you. 2 times. You made money on the spread, just like the bank does, and then you made money taking back the 9% that you were giving away to whatever bank, my bank was KeyBank. But you guys are like, I don't have any debt, this won't work. Oh, okay. You saw the hands go up for people that need money. So I take this 23 grand. And then I do a loan from my policy, and I give it to one of you, or I go to Private Money Club, and I lend it to somebody on Private Money Club that has a deal, and I charge them 12%. Then when they pay me the interest, we've already gone over this, I'm trying to beat this in your head, I take the 12%, and what do? I put it back in my bank, and I connect the dots in the bottom, on the middle, and I make a spread. But then some people are like, yeah, but 1% is not a lot. Okay, let's go back to this. Look at the screen. Year 2, Kevin's cash-on-cash return is what? 21%. If the cost of capital is 5%, and right now it's actually lower, I'm giving you the high number, is 5%, who here would have a problem paying the insurance company 5% when they are paying you 21%? Anyone have a problem with that? Because I don't. And you know the best part about uninterrupted compound interest? You want to know what the best part is? No matter what happens in your life, no matter what happens to the economy, no matter what happens in the markets, your money every single day goes where? Up. It's slow because compounding is a marathon. But every day you have more money you did the day before. And there's nothing in a specially designed whole life that can change that because it is not tied to the markets like an IUL. It is not tied to anything other than a promise and guarantee that the insurance company gave you. Does that sound like a better proposition than the bullshit lies we've been taught to do with our money? These are real numbers, folks, right off of the illustration, and this is even the new plan designs with the lower guaranteed interest rates. 21%, 26% year 5, 54% year 10, 115% year 15. Chris, I know what you're thinking, folks. I can see it in the front row. Dude, that sounds too good to be true. Who's thinking that right now? Just be honest with me. That sounds too good to be true. It can't be. Mathematics do not lie. Those are the numbers. They are absolutely true. You just don't know how this works. So what I've done today is I've given you the pimple on the elephant's ass. I have literally lit a fire under you that you now have to promise me you will apply this knowledge. You will, and listen, this isn't enough for you to make a decision, but it's enough to get you to do more due diligence. Who in here researches things before they buy them? You guys don't just like get in an Uber and then the Uber driver says to you, oh man, you should buy this NFT or you should buy this shit coin. It's going to go to the moon. And then you come home, you're like, man, or actually you're in the back of it and you're like, all right, I'm going to buy that. Any of you do that? Because somebody said, yeah, you're violating the laws of wealth. Do not do that. Folks, you need to take back control of your money. You need to start treating your money the same as you treat the bank's money, and you need to be the bank, and you can do it any of those ways, and I literally just showed you, and I don't know if you know this, I don't know if it's sunk in. I just showed you 3 wealth strategies, not complicated ones. I could have got real technical, but it's 3 simple wealth strategies, and everyone in this room easily could make and generate and create 25 to 100,000, maybe even more, if you were paying attention. People put their hands up, they want money. Other people put their hands up, I have money. Connect the dots, folks. It's so simple. If you want more of this, go to my YouTube. It's the Chris Naugle, and subscribe. I've got hundreds of videos teaching you this. Not just videos of me talking, case studies of actual clients that are actually using this to get all the money back for all the cars they ever buy, drive, and own. That jet, now not Ed's, but somebody else when they finance it. My partner bought a jet. Well, it's a turboprop Meridian, but he used his bank to finance the jet, so he gets all the money back for buying that plane. How many of you want all the money back for every single car or every single plane you ever buy, drive, or fly? Cool, right? And it doesn't have to be the one with the American flag on the back. You guys got to get around the campfire. You guys got to start getting around people that know how this works. Because if you don't, you're going to ride the roller coaster like I did, perpetually, over and over. Because everybody right now, I'm going to drop a bomb on you, feels rich. Do you know why? The government printed $5 trillion. They dropped interest rates to close to 0. The federal government exchanged money they printed out of thin air with the government for treasury bonds, and that money infused back in all of our pockets through stimulus, through PPP loans, EDIL loans. It is so easy to see why we all feel rich right now, but you know what? We're on our way back down the other side. You don't need to believe me. I'm a nerd with this stuff. It's going to get bumpy. You're going to hit some turbulence. The storm is already here. You just don't know. It's nice and sunny out. But you better be ready. You better get ready for this storm, I'm telling you. Because it's either going to be one of the most difficult times in your life, or it is going to be the biggest fucking opportunity of your entire life. It is going to be the opportunity that is going to set you, your family, your kids up for the rest of their life. Do you understand this? But it is not going to be an opportunity if you keep doing what you're doing. So folks, thank you so very much. Check out Horizon Trust out here to learn how to take control of your self-directed IRA and learn how that can fund you spending some time with me at the next exotic location for the boardroom. And also check out Private Money Club. Sign up for free and see where, it's just like eHarmony. I used to use eHarmony for dating when I was a pro snowboarder. Just in all transparency. It was easy. They got Tinder now. We didn't have that. And I'd go on, look at profiles in the state I was going to be at, read everything. In the middle, we'd chat, and then all of a sudden, boom. Not going to go there. This Private Money Club is exactly what you did for date, or what I did for dating for money. There's people with money that want to make more money. And there's people that need money to make more money. You just saw that. Thank you all for your time today. I appreciate it very much. God bless. Good job, bud. Well done. Give a round of applause.